Today, ladies and gentlemen, we're breaking down my $113,000 dividend stock portfolio, but more importantly, my worst performing stocks in this portfolio that equate to $5,388 in paper losses. So let's jump right into this. I'm never going to get tired of that. Welcome back, my passive income investors. As we break down my six-figure dividend stock portfolio, but more importantly today, I want to talk about how I'm managing and dealing with the down stocks, because we all have them in our portfolio, and I want to hear what your down ones are in that comment section below. And my three stocks right now that are dinging me the most if I were to sell today would be MO, Tesla, and GEO Group, equating for $5,388 in paper losses if I sold today. But instead of reaming on about them here, let's head on over to my stock portfolio and actually take a real physical look. So come on, guys, let's go. All right, let's just start with the news that we're all worried about that keeps happening time and time again that has to do with these tariff and trade wars, and they like making these impactful headlines. They love making these. These sell for them, man. Slump in the U.S. manufacturing knocks stock market to the lowest point in 5 weeks because, wow, 5 weeks low. Oh, scary stuff, man. U.S. sank to their worst loss in 5 weeks on Tuesday after surprisingly limp report of the nation's manufacturing stirred worries of the economy's strength. I'm not going to read through this. It seems to be the pretty common laid out story that is going on. Are we headed into recession? I do not know. I don't know what's going on. I just buy solid companies for passive income, and we're going to take a quick peek at all three of the portfolios, and then we're going to analyze my three worst positions that shouldn't even be affected by any of this news, but somehow are. And we're not talking the banks, though. I mean, the banks have been some of my least favorite stocks because great dividends, but no growth. But I'm only holding these for the income, so I don't mind holding them. Their numbers really haven't changed, but they're a little undervalued, I think, still. I think anything around 100, 105 is fairly valued to undervalued for something like Canadian Imperial Bank or Bank of Nova Scotia. Obviously, I don't know Bank of America, but there's no growth in the banking sector. After 2008, the regulations they keep putting on these things stop them from growing whatsoever. But heck, at least you're holding them for a good, stable dividend. They ain't going anywhere anytime soon, but they're not my worst performers. This is my tax-free savings account, by the way, where all of the money I'm making here is tax-free. But we're going to take a look, obviously, at MO and GEO as one of the majors, and then along with Tesla that I have in my managed account here that has also been beating my portfolio into the bloody ground. Now, should you be worried? Should I be worried? You can let me know in the comment section below, but I'm not overly concerned. We're finally seeing Starbucks, though, come into some fair valuation. I don't own enough of this to make a difference. This could drop another $20, and it really wouldn't ding my portfolio that bad. I just bought this because I want to be part of coffee, and it just never wanted to come down. But I always said, man, if this thing gets in the low 80s, it's a definite buy. So as I get some income into the rest of the year, I will definitely be funneling some more money into Starbucks. But what I think I'm going to do instead is I'm going to take the loss on this and then put it into my RSP and buy it back there. Because that way I can deduct the loss this year, and then on top of that, it'll be making me tax-free money, my tax-free savings account, because I'll be paying a lot more than the loss that I'm having on this in taxes if I have to pay the tax on it. But finally, my RSP, just to take a look at the only holding I have in my RSP, which is the index fund, guys, which is actually down a little bit. Shocking to see that. We've been holding up quite nicely, but I think, like I said, the markets are going to head flat probably for the next year. We need some real growth drivers coming in to bring the market up, and the only thing holding the market up is the tech stocks like Microsoft, like Apple. They seem to be on a trek that can't be stopped right now, but I said in my last video that I do think Microsoft is overvalued at this level, and I was debating on selling it. If it doesn't pop back into the 140s, I'll be kind of on edge whether I want to sell it and like just leverage it down and just hold cash for a little while and maybe consider buying a few more Apple shares. But I just like how fast they're growing. Their balance sheet has exploded lately, but just for where their valuation sits at versus their income is a little bit higher than I would be comfortable with. They trade at quite a fair PE right now, but even still, man, you can't get over how fast. Microsoft is probably one of the fastest growing tech companies out there right now. They're definitely smashing Apple by book valuation, not by profit margins or by money on the bank or whatever, but I mean, overall with their cloud computing and how fast gaming is growing, like they're doing exceptionally well. Before we finish up, we got to look at the RBC account before I hop into those, because we can see now that 3M that I bought on your behalf is down a little bit today. Not a whole lot. Like I said, I only own about $1,000 worth in Canadian dollars, or about 622 in the USDs, and it's down 41.55 today. Kind of shocking. We're down a little bit on the currency exchange, and it took one heck of a hit today on that news, which again, what does it have to do? Does 3M have a lot to do with manufacturing? Probably. They sell a lot of products in those niches, so I mean, that might be why they're taking such a big ding. People are worried about their books coming up. But more importantly, let's jump into the three companies, including MO, GEO, and Tesla, starting with MO, the one that many people have been looking at that I
think is insanely undervalued. And why do I think it's undervalued? Why do I keep saying this? Why do I keep bringing that up? Well, it's this charting right here. Now, these companies, for the heat they've had, for the news going on, the revenues are fine. They're doing quite exceptionally well with the revenues. In fact, they're hitting pretty good highs in the last year just on quarter-over-quarter revenue. But as we can take a look, guys, their stock price has fallen miserably from Q4 of basically 2017 to today, where we're looking going into Q3 of 2019, which we should see some earnings coming out this month. To be neat to see what's going to happen. But I'm telling you, if MO smashes earnings here, we're going to see an incredible, hopefully, rally. Because, I mean, one good earnings for this company is going to take this suppressed price and probably jump it 15 or 20%. I could see that happening. I'm not saying a full recovery into the price range we were sitting at back here, but I just can't see this getting much lower because, again, their books just aren't changing for how bad the news is. One of the only reasons I've been buying the living crap out of that company. And it's also one of my worst performing companies because for the scale that I have in it, I'm down, I think, a couple $1,000s on that position. But maybe we'll take a look at Tesla here as well. Tesla's been one of those companies that I knew I was paying a premium for. Like, I just wanted to be a part of this company, and I want more shares in it, and I will be picking up some more. And I don't even care if it's 1 or 2 shares. I'll be buying more this year. Now, looking at, I love this new thing Scotiabank put up here, but looking at their earnings versus stock price, this is a company that we all know has had a hard time showing earnings, but my God, the cash flow that comes through this guy is absolutely unbelievable. And the moat that they have, I'm not going to argue this. I'm sure you guys all hear the back and forth, whether you should buy or sell Tesla. It's overvalued, undervalued, whatever. I'm holding this as a long-term deal, and I'm going to put it into my tax-free savings account. It will be one of the companies I end up buying in my TFSA, which is another reason I was debating on selling a bit of Microsoft. Once it hits back up to those highs, if it does return over the $1.40 mark, I wouldn't mind just leveraging a bit out, maybe putting some of it into Tesla, just because I'm young, long-term, 5 to 10 years out. This could be the dominating car manufacturing company. I can't see anybody beating them right now or even competing in their league, and they're doing exceptionally well with what is going on in China, considering all of this tariff drama, leading me into my worst performing stock of all time. This one, oh my God. I'm on the fence on what I want to do with this guy. I am not willing to sell this at the level it sits at because, again, I see it as being extremely undervalued. It looks very similar to a company like MO, where we can see that the chart price has just tanked into the toilet, but revenues are actually going up. And I don't think revenues are going to stop going up for a while. We just have to get to this political trade drama and the next election cycle that is coming up. The next election cycle is going to debate everything with this company, but if the election cycle goes well and this company starts losing its microscope that it has on it, and it deserves it, don't get me wrong. This company has had a lot of drama in it lately. But you can't just focus on that one part of the company and presume that's the whole thing. And it's the same thing with MO. Like, you're going to have these mild issues, and it's not something this company is, not mild issues. These are pretty substantial issues. Let's be real. They're talking about privatizing the prison system. But I bought into this before any of that news even came up. Like, I was buying it at the $23 price, and I thought I was getting a deal. And now they're saying the analytical rating on this company, if we go into the analyst, I wonder if it'll show me in here. They actually have a $23 analyst rating on it. It's funny how we have one strong buy and negative and a hold. Like, could you ask for any more even ground here? Like, it's kind of crazy that way. But when we look at the balance sheet on this guy, they can afford to pay their dividend. The dividend will be continued to be paid for as long as the income keeps coming in. And the only way that income stops is basically if the government stops paying, but they can't stop paying because they have to deal with lifetime prisoners, children with issues. Like, there's good reasons for this company to be sitting where it's sitting. So because it's not over leveraged on my portfolio just yet, I might consider dumping a little bit more into this before the end of the year, even just selling off some of those Microsoft shares to dump at least a last 1,000. I like all my U.S. positions being leveraged in about 6,000 average buy price, and I also wouldn't mind adding a little more to BTI and then start leveraging them out of my managed portfolio. But the goal is to leverage and balance this portfolio as much as possible because this is my long-term sustainability portfolio for passive income. I make all my money in here tax-free. It equates to about 4,200 Canadian a year. Absolutely incredible for what this portfolio has done for me, and it's had an incredible performance. But right now, GEO Group's under the microscope. I still like the balance sheet. I still like the company. They do have some work that needs to be done, but at these levels, I can't. Could it go lower? I'm curious to if it even can, because again, just looking at the charting here, guys, after a while, earnings have to equate for something, even with bad news. So, I mean, is this the bottom? Maybe not. If we take a look at the charting here real quick, I know I'm talking a lot about this one, but it's my worst performing one, guys. But if we go again into the charting here and take a look at the long-term perspective, this company has experienced extreme volatility in the past. We're talking about a company that can go from lows of the low 15s all the way up to the high 30s and then come right back down. So, I mean, expect the volatility, right? But I think we're playing on the low trend of it. If it holds here, we probably may have found a bottom depending on how bad this political cycle becomes. But at least for the next year till we get through this political cycle, things are going to be rocky for this guy. But again, the rate of return, guys, over this entire company's history has been absolutely absurd. It's kind of like a REIT that's not really a REIT. But even still, guys, I enjoy having it in my portfolio. I wish I was buying it now, though. But even still, I wouldn't mind picking up a few shares at this level. That's why I have it set up on a drip. But other than that, those are my 3 stocks that are doing the worst performing. I'd love to see what you guys think in the comments section below.
Remember, guys, if you enjoyed this video, consider slapping a like and subscribe. And we are now 866 passive income investors strong, all because of you guys. And I look forward to the future content as we look at everything from real estate, my personal portfolio, and what I plan on doing as a magician, guys. Lots of plans working out on that too. But stick around, stay cool, stay awesome. I look forward to chatting to you guys real soon.